Okay, let's dive into this, because today we're unpacking an earnings report that absolutely sent shockwaves through the market. Welcome to this explainer on Affirm Holdings and their massive Q2 calendar year 2026 earnings. If you follow the fintech space, this latest drop is literally a masterclass in why you can't just skim the headlines. Right out of the gate, the initial numbers looked spectacular, didn't they? Revenue beat expectations, forward guidance was crushed, and the stock immediately jumped over 6% in after-hours trading. But, well, in the financial world, things aren't always exactly what they seem. We really need to separate the genuine operational signal from the accounting noise here.
So here is the billion-dollar question we've got to answer today. Did Affirm's fundamental business model suddenly become 5 times more profitable overnight? Or are we just looking at a really clever financial illusion? When a company reports earnings that completely blow past Wall Street estimates by a factor of 5, you have to stop and take a breath. We need to dig past those flashy headlines and look at the raw data underneath to figure out what's a one-off anomaly and what's actual sustainable growth.
Just look at this number, $4.62. That was the headline earnings per share that Affirm reported. To put that into perspective, Wall Street analysts were looking for an EPS of just 85 cents. Affirm didn't just beat the street, they completely obliterated it. Reporting an EPS more than 5 times higher than consensus, it is absolutely no wonder the stock popped 6% right away. When trading algorithms see a beat of that magnitude, they just hit buy and ask questions later. But we're here to ask those questions.
Now, what's really interesting is the magic trick behind that massive $4.62 number. A staggering $1.45 billion of it came directly from a deferred tax asset release. Okay, if you're not an accountant, don't worry. Just think of this as corporate paper magic. It's a non-cash gain. It didn't come from more people actually using Affirm to buy sneakers or laptops. So while that EPS number looks incredible on paper, it is absolutely crucial that you do not model this as recurring profitability. It's a one-time event that artificially inflated the bottom line. So if we strip away the illusion, what's the real operational picture? Well, here's the reality. And honestly, it is still fantastic news for the company. When you strip away that tax illusion, the actual revenue generated by Affirm's business came in at $1.17 billion. That topped Wall Street's $1.11 billion consensus estimate. This is what we call a clean beat. It proves that the core operations of the company are exceptionally strong, even without all the accounting gymnastics. But to really get how they generated that $1.17 billion, we need to look at the true lifeblood of any payment network. And that lifeblood is gross merchandise volume, or GMV. This metric is the total dollar value of all transactions processed through Affirm's platform. GMV grew by a super impressive 36% year over year, reaching a massive $14.1 billion. That right there is the real operational success story of the quarter. It tells us that significantly more consumers are actively engaging with Affirm at checkout, and more merchants are relying on them to drive sales. Pulling off 36% growth on a multi-billion-dollar base? Not easy. It shows incredible momentum, but it begs the question, where is all this volume coming from? Are they just burning through marketing dollars to find new buyers?
Actually, no. And the answer to that is arguably the most bullish data point in the entire report. A staggering 96% of Affirm's transactions came from repeat customers. Only 4% were from first-time users. Think about how powerful that is. This is Affirm's competitive moat. It demonstrates intense brand loyalty. Once someone uses Affirm, they clearly love the experience enough to keep coming back. From a business perspective, this is a game changer because it organically lowers customer acquisition costs over time. You aren't constantly paying to replace churned users. Your existing base just keeps compounding. And this brilliantly illustrates why the stock sustained its post-earnings momentum. It wasn't just about what Affirm did in the past. It's about what management says they're going to do in the future. Wall Street was estimating that Q1 fiscal year 2027 revenue would be roughly $1.17 billion. But Affirm's management stepped up and guided for revenue between $1.19 and $1.22 billion. They aren't just clearing the hurdle, guys. They are actively raising the bar. When management confidently guides higher than the street expects, it signals deep internal confidence in their pipeline. But they didn't stop at the next quarter. For the full fiscal year, management is targeting a gross merchandise volume exceeding $64 billion. That is a staggeringly bold target. It implies continued high teens growth on an already massive foundation. This completely shatters the old narrative that buy now, pay later was just some temporary pandemic fad, right? If Affirm hits this $64 billion target, it firmly establishes their payment model as a permanent structural fixture in the modern consumer finance landscape. So, we've stripped away the tax illusion, established the clean revenue beat, and seen the bold guidance. Where do the professionals stand? Right now, the broad analyst consensus is a strong buy, carrying an average price target of roughly $92. Based on where the stock was trading post-earnings, that implies about an 18% upside. But you know how it goes with any high-growth tech or financial stock. Wall Street is far from unanimous. The market is a constant debate, and to truly understand this company's position, we have to weigh both sides impartially. Looking at the current Wall Street debate, you've got firms on the bull side, like Oppenheimer, who have slapped a $100 price target on the stock. They're heavily focused on Affirm's proprietary tech advantage, their continuously expanding merchant partnerships, and the broader generational shift of consumers ditching traditional high-interest credit cards. But we've got to listen to the bear case, too. Wolfe Research, for instance, holds a hold rating. They argue that Affirm is currently trading at about 24 times expected 2028 earnings, which, let's be honest, is a very rich valuation, especially compared to traditional fintech peers. They also point to two very real macroeconomic risks: higher interest rates, which directly hurt Affirm's funding costs, and fierce competition from massive players like Apple Pay Later, Klarna, and traditional banks playing catch-up. Both sides bring highly valid arguments to the table.
Translating this fundamental debate into an actionable technical roadmap, we know volatility is pretty much guaranteed. Right now, the stock is in a consolidation phase. The crucial line in the sand to the upside is resistance at $86.90. If the stock can break above that level with heavy trading volume, technical analysts see a clear path toward that $100 price target. However, risk management is absolutely essential here. On the downside, critical support sits at $69. A structural break below $69? That would invalidate the current bullish setup and could trigger a much deeper, painful pullback.
So the crucial point is, how do we synthesize all this data? Well, first, fundamentally, the business is firing on all cylinders. That GMV growth and the clean revenue beat show stellar operational execution. Second, completely ignore that 4.62 EPS headline. We know now it's just accounting noise. Keep your eyes locked on GMV, revenue growth, and profit margins. And finally, recognize that because of its demanding valuation, this is a high-conviction growth play. It really only belongs in portfolios with a multi-year time horizon and the stomach to tolerate 20 to 30% drawdowns. For long-term holders, the growth story is totally intact. For new buyers, patience is key. Waiting for a pullback to support or a confirmed technical breakout is for sure the prudent move.
Which brings us to our final thought. Affirm's $64 billion target suggests they are taking a massive bite out of traditional finance. But the ultimate question remains, are we witnessing a temporary feature, or will buy now, pay later actually replace the plastic credit card entirely over the next decade? It's a fascinating shift in consumer psychology and economics to keep an eye on. As you ponder that, remember that this explainer is meant to help you decode the data, but you should always do your own diligence or consult a financial advisor before making any investment moves. Thanks for hanging out with me to unpack these numbers, and I'll catch you next time.